So what I want to talk about today is how we helped someone have enough money in retirement and provided guarantees that they would always have the income that they wanted. So a little bit of information on this person's background. He is 63 years old right now, and he is planning on retiring, fully retiring that is, at 67. So retirement date, 67 years old. He does enjoy what he does. He's a really nice guy. He's an architect, so he enjoys his job. But at the same time, he is at a point where he'd like to retire and move down to a warmer state with his wife. So as an architect, he has earned just about $100,000 per year. It's come out to about $95K per year. That's been the before tax number, and we do look at the after tax numbers too, as that's very important. But that's been his income. When he retires, he's going to have a few fixed income sources that he can count on. So when we put everything together for him, what we wanted to look at first was, what's your life look like right now if we make zero changes or don't put a plan together at all, specifically for your retirement? So his fixed income will be Social Security starting at age 67. It'll be about $34K per year. That's what he'll get. His wife at that time will get half. Call it $17,000 per year. And then he'll also have a small pension from a past employer that'll give him just about $5K per year. So when he retires, this is what he'll have at 67. So age 67, no longer working. When you tally those up, what you will get, just about $55K. But if you'd like to see some numbers here, let's get this giant calculator up. There you go. 34,000 plus 17,000 plus 5,000 gives you 56K. Okay, so that's the income, 56 grand per year. However, it doesn't give him enough because the target amount is $95,000 per year. So that means we have a gap of almost $40,000 in this example. So let's just call it that. Gap 40K. So how do you replace that $40,000 without taking on any risk? This individual is very, very simple. He doesn't really like the stock market. He has money in there, but he's not comfortable with it. It causes him a lot of stress. He does want to move some of it out, maybe all of it, but some of it has performed well, but he's not comfortable with the market. He's not into investing in real estate or creating passive income streams. He says, how do I just use some of the money that I have right now to make sure that I never run out? Like, that's my main concern. And if I can leave something to my kids too, I would love to do that. But I just want things simple in retirement. I want to have enough money and be able to enjoy myself with my wife and visiting my kids when I can. So totally get that. Here's how we can do it. His net worth today at age 63 is just about $1.2 million. And he's very liquid. He doesn't have much debt. He's got a mortgage that's a little bit more than 210 grand, but net worth, so netting that mortgage, accounting for that, worth about $1.2 million. And he's got $750,000 in a brokerage account, which some of it is in the market, which he's not that comfortable with, but at the same time, we've seen it perform. So we don't want to move all of that out, but he doesn't want all of it in there. So that's where you do need to have those conversations to see really what makes the most sense from a numbers perspective, and then also what provides the most amount of peace of mind, because that's important. Like, personally, If something is going to deliver me just killer returns, but I'm not happy or it stresses me out, I'm always thinking about it, it's not for me. And that's typically how I like to approach these scenarios, because peace of mind is important. If we're stressed out, thinking about money all the time, it's like we can't enjoy our retirement in this case or other things that we're doing. So what we want to do is fill that income gap. So we took half of that, $375,000, and moved it into an annuity. And the specific annuity, the purpose of it is not to grow his money safely. It's important to set expectations properly with annuities. Here's the word that I like the most: to guarantee income in retirement. Where we came up with 375 is because if he puts $375,000 into an annuity right now at age 63, what'll happen is at age 67, this annuity will guarantee income of, guess how much money? $40,000 per year, which fills that gap. So where an annuity can work well is a case like this, where someone says, I just want to keep things simple. I don't want to take on any risk. Yeah, I might be able to get a little bit higher income if I looked at rental real estate or something like that, but I'd prefer not to. Like, what I'm very interested in is putting money, or is making sure that I have enough guaranteed income forever. That is his main point of interest. So let's take a look at the annuity option here. Here's one page of the illustration that is going to highlight, guess what? The guaranteed income. So there's the word I like the most. This is why someone would get an annuity, where I've got the guarantees there, peace of mind. I don't have to think about it or worry about the money fluctuating or going down. Like, I know what I'm getting in income. So he purchases the annuity at 63. It shows 64 here because this is his age at the end of the first year, which not all insurance companies do that, but I know it can be confusing. But he deposits $375. He takes no withdrawals until he's 67. So he actually starts taking income at 67, which is year 5 in this example. And then at the end of year 5, he would have turned 68. That's why it's got 68 here. But here's the income. And it's guaranteed to pay him $40,000 per year forever, even if he exceeds that 375. And if he passes before getting a total of 375, there will be a balance left over. There will likely be a balance that would be paid to his beneficiary, his wife in this case. You'll see on the illustration what's called a death benefit for the annuity. It's not like a life insurance death benefit where it's paid income tax free. But my point is, the insurance company will not just keep all of the money if you die before getting your principal back. If he lives for a while, well, then he gets a lot more back than what he paid into the product, which is nice. So to summarize this, here's what we like to do for cases like this. And this helped him. It helped me a lot too. So starting here, we laid out what his life looks like if he does nothing. So his working income has been $95,000 per year. Why it dips here for 4 years is because he actually just semi-retired. So it's about $75,000 and change. However, his wife just started taking Social Security. So what that does is get his before tax income very close to where it was when he was working. And after tax, we're very, very close. And he's got more money in cash and other assets too, more than just the $750. Remember, his net worth was $1.2. He's very liquid. He's in a good spot. At 65, he starts to get a small pension from a former employer. And then at 67, he fully retires. So there's his Social Security. His wife's Social Security then increases because it becomes 50% of what his is, which is nice. He's got his pension. And there's that $56,000 figure we mentioned before. After tax, comes out to about $49,000. We did go over this with his CPA. The net numbers will be a little bit higher than this, but again, this was meant just to provide a ballpark here. So let's see what it looks like when we make the changes. Here we've got retirement with changes. I'm going to start at age 67 here. And what do you notice? There's your Social Security for him, his wife, the pension. Oh, there's the annuity income. Before tax, after tax. Now you'll notice it's a little bit higher for a period of time, and then it goes down. The reason why is because this is a non-qualified annuity, meaning he's not funding it with an old 401k or IRA. It's funded just with cash. So when he gets his $375,000 back, the principal he deposited, he doesn't have to pay income tax on that. He only pays income tax on the gains. So what that ends up doing is when you're getting your principal back, tax rate's a little bit lower because this is a return of principal, so I'm only paying income tax on this material to the left. Then once I've got all of my principal back, I've got to pay income tax on everything because it's all gains. And those taxes are not going to be exact. This is something we put together, run it by the CPA, and then tax rates do change over time too. So we're going to have differences there. But that is just meant to show what his after-tax income will look like. So then, what his life looks like. He's got enough income. The annuity accomplished that. Call it $95K per year. He's happy because that's always been enough money for him and his wife to live on. Woohoo! And then he can do whatever he'd like with his other assets. So he's got $375 left over then, which he could leave in the market. But when we discussed that, the feeling was just like, he's not that comfortable with it. And I had a hard time with this too, because we've looked at the performance and it's been performing. Like, I don't know that I would move all of it out. So we recommended maybe leave some of it in there and then put some of it into other safe areas if that's what you're more comfortable with. And then, of course, show him the numbers so he can see what it looks like. But one alternative we looked at was moving that into a high cash value life insurance policy, which we would not do in one lump sum. So we could either move it into cash and then feed the policy, or leave it in the market and feed the policy. We looked at $75 per year. And check this out. Here's why we did this. Or here's why we proposed this. Let's get rid of all this. Okay. So here's the life insurance policy. What do you notice? You get a total of $375 in over 5 years. He gets his money back just about year 5. Year 6, he is positive. There's your annual rate of return. This does not display the internal rate of return. That would be positive in year 6. But this is just the yearly growth rate on cash value. So it looks pretty good, especially considering the fact he's starting at 63. This is a Guardian 10-pay policy. We just juiced the cash value, which is what we always do. So why this option was somewhat attractive or very attractive to him was because his income is where he wants it to be. This gives him the most peace of mind where he doesn't have to worry about dipping into other assets that he has. At the same time, with a life insurance policy, it's with a major mutual company and designed properly, we see it continue to appreciate over time. The net return is going to vary as the dividend rate adjusts, but it'll perform. Like, I've seen Guardian deliver consistent results over time, which is a big reason I like them, any of the major mutuals. So during retirement, if he says, hey, I need or want more money than what I'm living on because we've got this thing called inflation, or I just want more money, it's mine, well, he's got access to this cash value And he doesn't have to worry about the value ever taking a dip. If we've got a recession or if the stock market crashes, he doesn't have to worry about that. That's why cash value life insurance is used by so many people. So he's got the cash value on the back burner. He can also access it tax-free, provided we don't lapse it, which would mean cash it out, or if we don't trigger a MEC, a modified endowment contract, but it's easy to prevent the taxable event, I can access it tax-free. And if he doesn't need it, here's what he really liked. He wanted to make sure he had enough income, but if he dies at 90, call it, he might live longer. He's got a lot of longevity in his family. There's the death benefit that's paid income tax-free to his kids, his 2 daughters. So now he can leave money too. His net worth is about $1.2 million. Now he can leave that through a life insurance policy. He's actually got a smaller life insurance policy. It's worth $250,000 right now. That'll increase over time too. So he's in a good position where he can spend the money he wants in retirement, continue to grow money on the back burner. And I don't know that I would even move this much into it just because his money in the market has performed well. Maybe we cut this in half or make it 30%, depending on what he wants. It all depends on his comfort level. But maybe you don't move it all in there. You leave some in the market because it's been performing well. And then you've got this in the back burner. You leave a death benefit. This is a nice option for people, in my opinion, that helps them have the income they want in retirement and still have money that they can dip into if they need or want to. And then lastly, still leave a legacy. So I hope this made sense. This is a bit of a simplified overview. The actual plan, we showed a couple more options and such, but I hope you enjoyed it. Let us know if you have any questions. Would love to hear any thoughts. And as always, I hope this helps. Thanks so much for watching.